Welcome to The Explainer. Today, we're diving right into the dawn of a completely new era for what is arguably one of the most iconic companies on the planet. For over 6 decades, the names Berkshire Hathaway and Warren Buffett have been literally synonymous. You couldn't think of one without the other. But as of January 2026, the torch has officially been passed. So we're going to break down this highly anticipated transition of leadership, unpack the strategy of the new CEO, and figure out what it all actually means for the future of this massive financial empire.
Okay, take a second to really wrap your head around a number like this. 5,502,284%. Yeah, you heard that right. That staggering figure represents Warren Buffett's cumulative return over his 60-year reign, from 1965 to 2025. Just to put that into a little perspective for you, the S&P 500 returned a little over 39,000% during that exact same time frame. It's not just a good track record. It is, quite simply, the most successful investment career in modern financial history.
Now, what's really fascinating about this transition is how absolute the endorsement is. At the 2026 annual meeting, which was the first one with the new CEO fully at the helm, Buffett didn't just hand over the keys, he completely validated his successor, Greg Abel. Listen to what he actually said. He made it crystal clear to the 40,000 shareholders sitting right there in the audience that the transfer of authority was immediate, it was complete, and he genuinely believes the company is better off for it. So that begs the obvious question, right? Who exactly takes over an $865 billion conglomerate? We're talking about a company with over 390,000 employees and this incredibly complex portfolio of completely different businesses. It's the ultimate corporate succession puzzle. How do you replace an absolute legend? Well, let's meet the man who has spent 2 decades quietly preparing for this exact moment. Section 1. Who is Greg Abel? The ascent of an operator. You know, you might expect the next CEO of Berkshire to be this flashy, fast-talking Wall Street veteran, but that is not Greg Abel. He was actually born in a Canadian oil town and started out as an accountant at PwC way back in 1984. From there, he moved over to a geothermal company called Cal Energy in '92, which eventually acquired Mid-American Energy. Then, Berkshire bought a controlling stake in 1999, and Abel just kept working his way up, eventually becoming CEO of that energy division by 2008. He definitely didn't just inherit a throne. He really earned his stripes on the ground, building Berkshire Hathaway Energy into this massive, diversified global utility platform. Actually, let's look past the corporate resume for a second, because his work ethic is the stuff of a legend. Long before he was managing billions of dollars, Abel was getting paid literally a fraction of a penny to deliver advertising flyers. He used to collect discarded bottles just for the deposit money, worked as a laborer for a forest products company, and even spent time filling fire extinguishers in high school and college. It's safe to say his background looks a little different than your typical Fortune 500 CEO. Honestly, even Buffett himself has publicly admitted that Abel simply works harder than he does. Section 2. Allocator versus operator, a shift in leadership style. This is where things get really interesting, because we're witnessing a fundamental shift in how this colossal conglomerate is managed on a day-to-day basis. Buffett, as we all know, was the ultimate master allocator. His style was famous for being incredibly hands-off. He'd buy great businesses, trust the management implicitly, and essentially let them run completely free while he sat back and read annual reports. Greg Abel is totally different. He is a hands-on operator. He intimately knows the plant floor. He visits the sites. He actively pushes the subsidiary managers on things like efficiency, capital projects, and tight operational discipline. It's a completely new rhythm for the entire company. But if you're suddenly panicking that the whole culture is getting thrown out the window, don't worry. The underlying foundation isn't going anywhere. Abel was heavily mentored by both Buffett and the late Charlie Munger, and he is fiercely maintaining their decentralized structure along with these 4 legendary investing pillars. Whether it's sticking to their circle of competence, demanding a structural economic moat, requiring stellar management, or insisting on a margin of safety on the price, the core philosophy remains exactly the same. That being said, the portfolio is definitely evolving. Just look at these recent tactical moves. Step 1, Berkshire significantly trimmed its massive position in Apple. And that wasn't because Apple is bad business suddenly, it was simply to reduce their massive concentration risk and smartly lock in some gains. But then, look at step 2. They deployed $4.3 billion into Alphabet, Google's parent company. This is a huge signal. It shows a strategic willingness to invest in companies where AI capability provides a truly defensible, durable economic moat. Section 3, the $397 billion question.
deploying the war chest.
Now we arrive at the single biggest financial challenge, and honestly, the biggest opportunity facing Greg Abel right now. Just look at all those zeros. $397 billion in cash. Now, I know some investors get really anxious about cash drag, having all that money just sitting around not earning high returns. But under Abel, this patience is treated as a strategic feature, not a bug. Think about it. They possess the unprecedented optionality to swallow a $50 billion acquisition target whole instantly, without ever needing to pick up the phone and ask a bank for financing.
So where does a pile of cash that massive actually come from? Well, it's all about the engine room of Berkshire, insurance float. When you pay your auto premium to Geico, Berkshire gets to hold on to that cash before they ever have to pay out a claim. By early 2026, this float had ballooned to roughly $176.9 billion. It acts as effectively free, permanent capital that funds the expansion of the rest of the empire. It's just a brilliant, self-reinforcing, compounding cycle. So, the burning question, what is he actually going to do with it all? Well, he's going to stick exactly to his circle of competence. Don't expect him to go on some wild spending spree chasing highly valued tech or software startups. Instead, we can expect aggressive capital deployment right into energy, specifically things like renewables and grid modernization, which is exactly his home turf. We can also expect heavy investments into infrastructure, like the BNSF Railway and major pipelines. And of course, they'll continue expanding those crucial insurance underwriting operations. Section 4. The long-term verdict. Is BRKB still a core hold? If you're an everyday investor trying to make sense of this new landscape, the absolute best place to look is at the underlying business performance. And the numbers speak for themselves. Operating earnings jumped from $9.64 billion in Q1 of 2025 up to $11.34 billion in Q1 of 2026. That is an incredibly impressive 18% year-over-year growth. On top of that, their insurance underwriting earnings specifically shot up by 28%. So it's pretty clear the underlying businesses are really thriving under Abel's new operational rhythm. But all right, to be totally objective here, we have to talk about the elephant in the room, the size penalty. It's the primary risk factor, and it's simply the inescapable law of large numbers. Berkshire Hathaway now hovers around a $1 trillion market cap. It is just a mathematical reality that compounding at that massive scale makes it incredibly difficult to replicate the explosive high percentage returns they achieved back in the day when they were managing mere billions instead of a trillion. Even with that reality check, Wall Street remains highly constructive on the stock. Right now, the 12-month average price target for the retail-friendly B shares sits right near $536.67. That implies a solid 9% upside from recent levels, maintaining a really strong consensus buy rating. So the broader market clearly believes in the smooth execution of this leadership transition. As we fully step into the Greg Abel era, it leaves us with one final incredibly important question to ponder. Are you betting on the man or the machine? Warren Buffett spent 60 years carefully building an institution that was entirely designed to outlast him. And looking at the data we've covered today, it seems that machine is still running at absolute full throttle. Thanks so much for watching The Explainer, and I'll catch you on the next one.